Hello everyone, welcome to the Stock Trading Tutor channel. If you'd like to create a free Demat account with Alice Blue, click the link in the description and fill out your details. You'll also get intraday recommendation calls and you can learn robo trading software for free. Now, let's look at future contracts. What is a future contract? A futures contract is a legal agreement to buy or sell a particular commodity or asset at a predetermined price at a specified time in the future. Futures contracts are standardized for quality and quantity to facilitate trading on a futures exchange. The buyer of a futures contract is taking on the obligation to buy the underlying asset when the futures contract expires. The seller of the futures contract is taking on the obligation to provide the underlying asset at the expiration date. So let's look at an example of this futures contract. If Farmer Sam sells a December corn futures contract at a price of $4.5 per bushel, the contract buyer is purchasing this December corn contract at a price of $4.5 per bushel. As the seller, Sam is locking in a $4.50 selling price for 5,000 bushels of his corn that he agrees to deliver in December, while the buyer is locking in a $4.50 purchase price for 5,000 bushels of corn that she agrees to receive in December. So let's look at the characteristics of the futures contract. First is the lot or the contract size. In the derivatives market, contracts cannot be traded for a single share. Futures contract consists of a fixed lot of the underlying share. The size of this lot is determined by the exchange on which it is traded on. It differs from stock to stock. Now let's look at the expiry. All three maturities are traded simultaneously on the exchange and expire on the last Thursday of their respective contract months. Now let's look at the duration. Contract, a futures contract is an agreement for a transaction in the future. So futures contracts are available in durations of 1 month, 2 months, and 3 months. These are called near month, middle month, and far month, respectively. So let's look at the importance of this type of contracts. It can be traded on an organized exchange. It's a standardized contract term. It has daily settlement and so it has more liquidity. It requires margin and the counterparty is minimum. The interest of buyer and seller are safeguarded to a great extent. So let's look at the common terminologies used in futures trading. First is spot price. This is the price at which the asset is traded in the stock market. Then there's the future price. This is the price at which the futures contract trade in the futures market. Next, let's look at the contract cycle. This is the period over which the contract gets traded. Then there's the expiry date. This is the date specified in the futures contract. So this is the date that the contract will expire. Next, let's look at the contract size. This is the amount of assets that have to be delivered under one contract. Now let's look at some more common terminologies. Here is basis, which is the future price spot price. Now next is the cost of carry. This is the cost of maintaining or carrying a forward position over time. Initial margin. This is the amount which must be deposited in the margin account at the time a future contract is first entered into the initial margin. Mark to market. At the end of each trading day, the margin account is adjusted to reflect the investor's gain or loss depending upon the future closing price. Now let's look at the three types of future contracts. First is the stock futures trading. This deals with shares mainly. Next is the commodity futures trading. So this deals with gold futures or crude oil futures. Then there's the index futures trading and this deals in stock market indices. Now let's look at the steps involved in futures trading. First, choose a suitable contract based on exposure maturity date. Then place a margin to buy a contract. The brokerage and transaction fee will be charged. On a daily basis, mark to market will take place. The mark to market loss, also known as MTM loss, will reduce margin. The MTM gain will increase the margin. The contract is squared off when the margin balance is exhausted. Then the contract expires on the maturity date. Now let's look at how the futures contract differs from the forwards contract. So on the basis of meaning, the forward contract is an agreement between parties to buy and sell the underlying asset at a specified date and agreed rate in the future. However, a futures contract is the one in which the parties agree to exchange the asset for cash at a fixed price and at a future specified date. This is known as a futures contract. A forward contract is a tailor-made contract, and a futures contract is a standardized contract. And a forward contract is traded over the counter, that is, there is no secondary market. A futures contract gets traded in the stock exchange, so this is an organized stock exchange. This trade occurs in. The forward contract gets settled on the maturity date, and the futures contract gets settled on a daily basis. The risk is high with the forward contract, and with the futures contract, the risk is low. In the case of a default, since the forward contract is a private agreement, the chances of default are relatively high. In the futures contract, the chances of a default, there's no such probability since this happens in an organized stock exchange. The size of the contract for a forwards contract depends on the contract terms. For a futures contract, the size can be fixed. There is no collateral needed for the forwards contract. However, in a futures contract, an initial margin is required. In the case of maturity, the forwards contract, it matures as per the terms of the contract. And in the case of a futures contract, it matures on a predetermined date. Next is the regulation. The forwards contract is self-regulated and the futures contract is regulated by the stock exchange. The forwards contract is not very liquid, while the futures contract is highly liquid. Now let's look at some of the advantages of the futures contract. There is a transfer of risk. It shows an indication of future market trends like demand and supply. There's always margin trading, and the futures contract gives an idea about future stock prices or the index values. Now let's look at some of its disadvantages. First is that it's limited to a few currencies, it has limited dates of delivery, and it has a rigid contract size. Thank you for watching this video. For more videos on stock market and trading, please subscribe to this channel. If you'd like to create a free Demat account with Alice Blue, click the link in the description and fill out your details. You'll also get intraday recommendation calls and you can learn robo trading software for free.